Hello, everyone. Aaron Gaines here with Landmark Financial Services, coming to you with another educational video on student loans. Today, I want to talk to you about the difference between private and federal student loans. So, when a student submits their FAFSA or their free application for federal student aid and applies for loans to help pay for school, they will be put into a situation where they will either be granted federal student loans or not. This is based off of a lot of differing factors, of which may be parents' income, parents' assets, even students' income and assets, just to name a few. However, federal loans tend to have significantly more subsidies and opportunities for the loan borrower in repayment compared to your traditional private loan that maybe you would get from a bank or some other lender. So there are a multitude of different types of federal loans, of which, I really don't want to get into today. However, I do think it is important to understand the difference between a subsidized and an unsubsidized federal loan. So when the federal government grants you those loans, you are going to be either granted subsidized, unsubsidized, or a combination of the two. This is important to understand as subsidized loans do not accrue interest while you are in school. Private loans tend to not offer this type of subsidy at all. Now, unsubsidized federal student loans accrue interest on the loans while you are actually in school. So as you can imagine, it is important to know what type of loans you were granted. It is an important factor to understand that federal student loans may offer, compared to private student loans, more advantages, more subsidies. So in next week's video, I will explain the different types of repayment plans that the federal government offers and how that can be advantageous to a federal student loan borrower.